You hop off a long-haul flight feeling like a champion of productivity. New job abroad, new apartment, new coffee ritual that definitely costs too much. Then tax season sneaks up like a cat at 3 a.m., and you realize the scariest phrase in the American language isn't, "we need to talk." It's worldwide income. If you're a U.S. citizen or green card holder living overseas, the United States still wants a report card on your income. But here's the good news. You have two powerful tools to stop double paying tax on the same money: the Foreign Earned Income Exclusion and the Foreign Tax Credit. Think of them as two different umbrellas for the same rainstorm. Pick the right one, open it the right way, and you stay dry. Pick the wrong one, and you're shopping for towels. The U.S. taxes you because you're part of the club, not because of where you stand on the planet. Your host country taxes you because you earned money on its turf. Two countries, one paycheck. That's the double tax problem. The fix is baked into U.S. law in two flavors. The Foreign Earned Income Exclusion, or FEIE, lets you take a chunk of your foreign salary or self-employment earnings and pretend it never happened for U.S. income tax, up to a limit that gets adjusted each year. There's also a related housing exclusion or deduction that helps with reasonable housing costs above a baseline if you qualify. The second flavor, the Foreign Tax Credit, or FTC, lets you keep the income in the U.S. tax base, but give yourself a dollar-for-dollar credit for the income tax you paid to your host country, limited by a formula so you don't claim more credit than the U.S. would have taxed that income. You already hear the question forming. Which one is better? It depends on how much you earn, how high your host country tax rate is, whether you're an employee or self-employed, whether you have kids and care about refundable credits, whether you still pay into U.S. Social Security or into a foreign system, and whether your income is salary-like or investment-like. Tonight, we're going to walk through the rules, demystify the tests, and then run real-life sketches so you can see how different choices change your bill. Start with the FEIE. It's the one everyone hears about at rooftop parties because it sounds like magic. Exclude foreign earned income up to a healthy number each year. Earned means wages, salaries, professional fees, and net self-employment income from personal services. It does not mean dividends, interest, capital gains, pension income, or rental income that you're not materially working in. Those sit outside FEIE land. To use FEIE, you must have a tax home in a foreign country and pass one of two tests. The first is the bona fide residence test. You are a bona fide resident of a foreign country for an entire tax year, January through December, with an intention that looks like a real life, not a tourist sprint. The second is the physical presence test. You are physically present in foreign countries for at least 330 full days during any rolling 12-month period that overlaps the tax year. Full days means midnight to midnight. Travel days are picky. If you fly into the U.S. and breathe American air at noon, that's not a full foreign day. Both tests are trying to answer the same question in different ways. Are you genuinely abroad, or are you just collecting passport stamps? If you pass one of the tests, you can exclude up to the annual FEIE limit of your foreign earned income. There's also the housing piece. If your reasonable housing costs in the foreign city exceed a base amount, you can exclude or deduct the excess. How generous that can be depends on your location and whether your employer provides the housing. Some cities with stratospheric rents have higher caps. One more nuance. The exclusion must be prorated for partial year qualification. Move overseas in August, and your FEIE for that tax year is roughly 5 months worth, not the full annual cap. The tax code has little patience for, but my lease started in September. The foreign tax credit is a different creature. It doesn't kick the income out of the U.S. return. It keeps the income in, computes the U.S. tax on everything, then gives you a credit for the foreign income taxes paid or accrued on foreign source income, up to a limit. That limit is the part people forget. You take your U.S. tax, multiply it by the ratio of your foreign taxable income in a basket to your total worldwide taxable income, and that's the maximum credit for that basket this year. There are baskets, the passive basket for interest, dividends, and the like, and the general basket for salary and business income. Unused credits generally carry back 1 year and carry forward up to 10 years, which is a lifesaver if your host country tax was high in a bad year and lower later. Here's the bit that trips people. You can't double dip. If you exclude income under FEIE, you can't also claim a foreign tax credit on that same excluded income. And there's stacking. Even if you exclude some income, the tax on your remaining income is computed using the rate you would have had if you hadn't excluded anything. That preserves marginal rates, so the exclusion doesn't push you artificially into a lower U.S. bracket on your other income. Translation? FEIE can shelter the dollars you exclude, but it won't always shrink the tax on dividends, interest, or a spouse's U.S. source income. Let's make this visceral with a pair of simple scenes. In the first, you take a job in a country with low or no income tax. Your foreign wages are solid, your host country tax is minimal, and your investment income is small. In that world, FEIE is often your hero. You pass the physical presence test or bona fide residence test, exclude up to the annual cap, maybe take a housing exclusion if your rent is spicy, and your U.S. income tax on wages shrinks dramatically. Because your foreign tax bill is tiny, the credit wouldn't have much to apply anyway, and you avoid feeding carry-forwards that might never get used. FEIE doesn't erase U.S. self-employment tax, it deals with income tax. If you're self-employed, you may still owe U.S. Social Security and Medicare unless a totalization agreement between the U.S. and your host country says you're covered abroad and you get a certificate of coverage. FEIE protects breakfast, it doesn't touch payroll. In the second scene, you work in a country with a high income tax rate. Think much higher than a typical U.S. effective rate. If you run your salary through FEIE, you may exclude a slice, but everything above the cap still sits in the U.S. tax base. Meanwhile, your host country withheld a hefty amount. The foreign tax credit shines here because those foreign taxes can wipe out your U.S. tax on the same income up to the limitation. If your host country's rate exceeds your U.S. effective rate on that income, you end up with carryovers that you can use in future years. In this world, FEIE can actually hurt because it blocks you from claiming a credit on the excluded slice while still stacking to raise the marginal rate on what remains. Result? More U.S. tax than necessary. The elegant move is to skip FEIE entirely, use FTC to the hilt, and let carryovers soak future income spikes. Different umbrella, same rain, drier you. Now we have to talk about housing, because rent is the ghost at the feast. If you qualify for FEIE, you may also qualify for a foreign housing exclusion for employees or housing deduction for the self-employed. The idea is simple. The tax law recognizes that living abroad can mean unavoidable housing costs above a U.S. baseline. You can exclude or deduct those reasonable excess costs, subject to caps that depend on your city. Company-provided housing counts differently than personally paid rent, and lavish extras aren't reasonable because they're on Instagram. The housing benefit doesn't exist in FTC land. It's married to FEIE. That's one reason some people use a hybrid. Exclude a portion of wages plus housing, then take FTC on the rest. Just remember the anti-double dip rule. No credit for foreign tax attributable to income you've excluded. Tests. Everyone fears the tests. Let's demystify them. Bona fide residence is not a stamp in your passport. It's the life you actually live. The tax home must be abroad, and your abode must not be the U.S. Abode is a squishy word that means where your life is centered. Family, home, economic ties. If you keep a household in the U.S., fly to London for a project, and leave your heart and couch in Austin, you might fail bona fide residence even if you hit day counts. Physical presence is cold math. 330 full days in any 12-month period. You can choose the 12-month window that maximizes your count as long as it overlaps the tax year. Travel days can ruin this if you don't plan. Those early morning flights home for weddings can cost you thousands. People who need the certainty of math pick physical presence. People who settle in for the long run tend to use bona fide residence. Both require that your tax home is abroad, which means your main place of business is outside the U.S., and your abode isn't stateside. That word state just raised another eyebrow. U.S. federal tax is one game, state tax is another. Some states cling to you like glitter, especially if you kept a property available, a driver's license, voter registration, or family there. California and a few friends are famous for this. You can be a federal FEIE champion and still owe a state return if your ties look like residency. If you're leaving for the long haul, cup the ties cleanly. Change your license, end your lease, register elsewhere, close the gym membership you never used. Tax law respects facts more than speeches. Let's switch lenses and talk about families and credits. The U.S. child tax credit and its refundable component can be affected by FEIE. Because FEIE lowers your adjusted gross income and removes wages from your U.S. tax base, it can reduce or eliminate the refundable portion some families expect. The FTC approach, keeping income in the base and wiping out tax with credits, can preserve eligibility for refundable and non-refundable credits in ways FEIE cannot. If you have kids and low U.S. tax after FTC, you might prefer the credit path. Two otherwise identical expats can end up with different answers solely because one needs the child credit and the other doesn't. This is why rules of thumb are dangerous and custom plans save money. What about forms and timing? The unglamorous part that actually decides outcomes. FEIE lives on Form 2555. You'll show your tax home, pick your test, mark the dates, and compute the exclusion and housing amounts. You can also give your employer Form 673, so they withhold less U.S. tax during the year if you expect to qualify, which helps your cash flow. The foreign tax credit lives on Form 1116, which is a little spreadsheet that separates income and taxes into baskets, applies the limitation formula, and tracks carryovers. Salaried people often use the paid method. Cash basis self-employed sometimes choose to use accrued to align with the year the liability arose. If you later get a foreign tax refund, the U.S. expects a redetermination. You recalc your credit for that prior year and may owe back some U.S. tax. Don't fear the math. Keep the letters and the refund slips, and your amendment writes itself. Self-employment deserves its own minute because the rules have sharp edges. If you're a contractor abroad, FEIE can exclude the net income up to the cap, but it won't remove self-employment tax unless a totalization agreement says your social contributions go to the foreign system, not the U.S., and you have the certificate to prove it. The FTC can credit foreign income taxes, but it can't credit foreign social contributions against U.S. income tax. Those are different universes. So the grown-up dance for a contractor is usually a three-step. Consider FEIE for income tax on the first slice plus housing, consider FTC for host country income tax on the above cap slice, and consult the totalization map to see whether you pay social tax to your host country instead of the U.S., and get a certificate of coverage to show the IRS. Without that certificate, the U.S. can still ask for self-employment tax even if you've been faithfully paying abroad. Let's run 3 compact stories to lock this in. First, the low-tax hub worker. You move to a place with a single-digit income tax. Your salary is mid-6 figures. Rent is high. You pick physical presence because your travel is predictable. You use FEIE for the capped portion. Tack on the housing exclusion because your city cap is generous, and accept that you will still owe some U.S. tax on the above cap slice. You also accept that FTC won't help much because your host country's tax on salary is small. You'd only create tiny credits. You ask HR to implement Form 673 so your cash flow isn't crushed by U.S. withholding that you'll later exclude. You keep a calendar to protect your 330 days and try not to blow it on a weekend trip stateside for a concert. You stayed dry with FEIE and housing, and you didn't waste effort chasing credits you can't use. Second, the high-tax capital professional. You move to a country with a top rate well north of U.S. effective rates. Your employer withholds heavily. If you used FEIE, you'd exclude a slice but then pay U.S. tax on the above cap portion, while the foreign tax that could have wiped it out is orphaned. You choose FTC and skip FEIE entirely. Your Form 1116 in the general category soaks up your U.S. tax on the salary, and the excess foreign tax carries forward to future years. Because you kept the income in the base, you also preserve U.S. credits that phase out with low AGI. Third, the entrepreneur with kids. You run your own shop from abroad, you pay high rent, medium taxes, and you want to maximize the refundable child credit. If you take FEIE, your AGI may drop, and the refundable piece may shrink or disappear. If you skip FEIE and rely on FTC, your U.S. tax can be reduced to near zero while your AGI stays high enough to claim the credit, subject to the year's rules. You run both scenarios with last year's numbers in a test return and discover that an all-FTC approach wins by a mile for your family. You write, FEIE is not equal always better on a sticky note and put it where you'll see it before next year's filing. By now you see why which is better has only one honest answer, the one that matches your facts. The last mile is housekeeping. Keep proof you actually lived and worked abroad. Leases, utility bills, visas, residence permits, employer letters, a travel log that shows nights in and out, and copies of foreign tax assessments and payments. If you use physical presence, maintain a month-by-month calendar of full foreign days that could stand up in a room with a very bored auditor. If you rely on FTC, keep the host country tax returns and the receipts that show what was ultimately paid in local currency and when. If you get a refund years later because of a host country audit or a late credit, don't panic. You'll do a redetermination and true up the U.S. credit. If you're married and your spouse has only U.S. income, model whether your FEIE stacking would raise the rate on that income unhelpfully. Sometimes the optimal strategy changes based on who earns what. Elections and revocations have rules. Once you claim FEIE, revoking it can bar you from using it again for a number of years, unless the IRS gives permission. Don't toggle casually. Test before you elect. Likewise, once you choose the paid or accrued method for FTC, changing methods requires a formal switch. The system will let you do smart things, but it punishes impulsive ones. You might be wondering about treaties. Income tax treaties don't erase the U.S. right to tax citizens on worldwide income, but they often help with tiebreaker residency tests and specific categories like pensions, interest, and royalty withholding. For salary, your host country's domestic law plus the treaty usually decide who gets first bite. The FTC then cleans up the double tax mess on the U.S. side. Social Security totalization agreements are separate from tax treaties. They decide which system you pay into and can save you from paying both. If your country has one, get the certificate. It's the golden ticket for audits on self-employment tax. We've covered what you need to stop double paying, which is the whole mission tonight. FEIE is a shield that makes part of your foreign earned income disappear from U.S. income tax if you truly live abroad and pass a test. It pairs with a housing break and works best when your host country income tax is low and your life is truly overseas. FTC is a sponge that soaks up U.S. tax using the foreign tax you already paid on foreign source income, limited by a formula, with carrybacks and carry-forwards that make it powerful in high-tax countries and for families who want to preserve U.S. credits. You can mix them thoughtfully, but you cannot double dip. Stacking prevents the exclusion from gaming your rate on what remains. Self-employment tax plays by Social Security rules, not by income tax rules, so check totalization maps. States can be clingy, so cut ties cleanly if you move for real. And whatever you choose, keep proof like a librarian and calendars like a pilot. If you remember nothing else, remember this. There is no single expat hack. There is only a small set of clear levers. Where you live and work decides your test. How your host country taxes salary decides whether the exclusion or the credit wins. Whether you have kids, investments, or self-employment changes the math on the edges. Run the two scenarios with your real numbers before you file. Pick the umbrella that matches your storm. Then, close the laptop, order that overpriced coffee, and enjoy the life you built abroad without paying for it twice.